Picture this: a young psychology student from Rhode Island, raised in a middle-class family where his father served as a judge and his mother as a teacher. Fast forward 2 decades, and that same individual has transformed $30,000 into $80 million through sheer trading prowess. This isn't fiction, this isn't luck, and this certainly isn't some get-rich-quick scheme gone right. This is the extraordinary true story of Michael Marcus, one of the most legendary commodities traders who ever lived. When financial historians discuss the greatest traders of the modern era, names like George Soros, Paul Tudor Jones, and Jesse Livermore inevitably surface. But there's one name that should be mentioned in the same breath, yet somehow remains in the shadows of trading folklore. Michael Marcus didn't just make money in the markets, he redefined what was possible. He didn't just beat the odds, he obliterated them so completely that his performance record reads like something from a fantasy novel. What makes Marcus's story truly remarkable isn't just the astronomical returns he achieved, but the path he took to get there. This wasn't some Wall Street insider with connections and capital. This wasn't a mathematical prodigy who cracked some secret code. This was a psychology student who stumbled into trading almost by accident and then proceeded to master it with such precision that his methods became the blueprint for an entire generation of successful traders. The numbers alone tell a staggering tale. Over the course of roughly 2 decades, Marcus multiplied his initial stake by more than 2,600 times. To put this in perspective, if you had given him $10,000 in the early 1970s, you would have received over $26 million by the end of his legendary run. His average annual compound return exceeded 48% for 20 consecutive years, a feat that surpasses virtually every known investment record in modern financial history. But here's what makes this story even more fascinating. Marcus achieved this during some of the most turbulent economic periods in American history. He navigated through multiple recessions, oil crises, currency devaluations, and massive market upheavals. While other traders were getting wiped out by these seismic shifts, Marcus was using them as stepping stones to build one of the most impressive fortunes ever accumulated through pure speculation. The journey began in Providence, Rhode Island in 1946, when Michael Phillips Marcus was born into a household that valued education, discipline, and intellectual rigor. His father's position as a judge instilled in him a sense of analytical thinking and methodical decision-making that would prove invaluable in his future career. His mother's role as an educator likely contributed to his later abilities as a mentor and teacher to other successful traders. Growing up, Marcus showed exceptional academic promise. He graduated Phi Beta Kappa from Johns Hopkins University in 1969 and went on to study psychology at Clark University. This background in psychology would become one of his secret weapons in the markets, giving him unique insights into market psychology and the behavioral patterns that drive price movements. During his time at Johns Hopkins, Marcus encountered a fellow student named John who made an extraordinary claim. He could double anyone's money every 2 weeks through trading. Intrigued by this bold assertion, Marcus began researching the world of financial markets to verify his classmates' claims. What he discovered was that John was completely fabricating his abilities, but in the process of investigating, Marcus fell in love with the markets themselves. Originally, Marcus had planned to follow a traditional academic path, perhaps becoming a professor like many of his peers from prestigious institutions. His intellectual background and analytical mind seemed perfectly suited for academia. However, the allure of the financial markets proved too strong to resist. There was something about the challenge, the intellectual stimulation, and the potential rewards that captured his imagination completely. This was the early 1970s, a time when the financial landscape was undergoing dramatic changes. President Nixon had recently abandoned the gold standard, creating unprecedented volatility in currency and commodity markets. The old rules no longer applied, and opportunities existed for those bold enough to recognize and capitalize on them. Marcus made the pivotal decision to move to California and begin his trading career in earnest. Armed with his life savings of $7,000, he purchased plywood futures contracts in 1972. This first trade would prove to be prophetic, as Nixon's price controls created artificial scarcity that drove futures prices sharply higher. Marcus's initial investment grew to $12,000, providing him with his first taste of what was possible in the markets. But this early success was largely due to luck rather than skill, and Marcus was about to learn some harsh lessons about the realities of professional trading. The markets have a way of humbling even the most confident participants, and Marcus was no exception to this universal rule. His initial success was followed by a series of devastating losses that nearly ended his career before it truly began. Starting with just $3,000 in one account, Marcus faced the brutal reality of commodity price movements. An early setback of $42,000 in corn and wheat contracts was financially catastrophic and emotionally crushing. These losses wiped out not just his profits, but put him deep in debt. The psychological impact of these early failures cannot be overstated. For someone with Marcus's intellectual background and academic success, the experience of losing so dramatically in a field he thought he could master was deeply humbling. Many would-be traders never recover from such setbacks, either financially or emotionally. But Marcus possessed something different, a resilience and determination that would define his entire approach to the markets. His first day in a brokerage house provided a perfect example of how little he initially understood about the trading world. A voice over the loudspeaker recommended buying soybean meal, and Marcus looked to his supposed mentor John for guidance. Instead of the confidence and expertise he expected, Marcus saw only confusion and uncertainty on John's face. When John asked Marcus whether they should follow the recommendation, the reality hit him like a thunderbolt. John knew absolutely nothing about trading. They bought the soybean meal anyway, and immediately the market began sliding downward. They lost $100 on that very first trade, a small amount by today's standards, but significant for someone operating with limited capital. More importantly, this experience taught Marcus a lesson that would serve him throughout his career. In the trading world, you cannot rely on others' claimed expertise without thorough verification. This harsh introduction to professional trading forced Marcus to confront some fundamental truths about the markets and about himself. He realized that success would require not just analytical ability or academic knowledge, but a completely different set of skills. He would need to develop emotional discipline, risk management techniques, and the psychological resilience to handle inevitable losses. Despite these early setbacks, Marcus demonstrated the persistence that would become one of his defining characteristics. Rather than abandoning his trading ambitions, he used these failures as learning experiences. He began keeping detailed records of his trades, analyzing what went wrong and why. He studied the behavior of successful traders, looking for patterns and principles that could guide his own development. During this period, Marcus was working as an analyst, which gave him exposure to different approaches to market analysis and risk management. It was in this capacity that he encountered Ed Seykota, a meeting that would prove to be one of the most important moments in his entire career. Seykota was a visionary trader who had recently graduated from MIT and developed one of the first computerized systems for testing and trading technical strategies. Seykota recognized something special in Marcus, a combination of analytical ability, psychological insight, and raw determination that could be molded into trading excellence. Despite initial resistance from others in the firm, Seykota took Marcus under his wing and began teaching him the principles that would transform his approach to the markets. The lessons Marcus learned from Seykota went far beyond simple trading techniques. Seykota taught him about money management, risk control, and the importance of trend following. More importantly, he helped Marcus develop the mental framework necessary for long-term success in the markets. Under Seykota's guidance, Marcus began to understand that trading was not about being right all the time, but about managing risk and maximizing the impact of correct decisions. This mentorship represented a turning point not just in Marcus's career, but in his entire understanding of what it meant to be a professional trader. The random, undisciplined approach of his early days was replaced by systematic methods and rigorous risk management. The emotional roller coaster of his initial failures gave way to a more balanced, professional approach to market participation. The timing of this transformation could not have been better, as the commodity markets were about to enter one of the most dramatic bull markets in history. The 1970s would see unprecedented price movements in gold, silver, oil, and agricultural commodities. For a trader with the right skills and mindset, these market conditions represented extraordinary opportunities for wealth creation. What happened next would become the stuff of trading legend, but the path to extraordinary success was anything but straightforward. Marcus found himself at Commodities Corporation, a firm that would later be recognized as perhaps the most influential training ground for traders in modern financial history. This wasn't just any trading house, it was an institution that would eventually produce more legendary traders per square foot than any other organization on Wall Street. The culture at Commodities Corporation was unlike anything that existed before or since. The firm operated on a simple but revolutionary principle: find talented individuals with the right psychological makeup, provide them with capital and mentorship, and let them develop their skills through actual market experience. It was a meritocracy in its purest form, where performance was the only currency that mattered. Marcus thrived in this environment, but his ascent wasn't immediate. The transition from struggling individual trader to professional fund manager required him to unlearn many of the bad habits he had developed during his early trading years. The firm's systematic approach to risk management was a revelation for someone who had previously operated more on instinct than discipline. Under Seikota's continued guidance and the firm's structured environment, Marcus began developing the methodical approach that would define his legendary career. He learned to integrate fundamental analysis with technical analysis, creating a comprehensive framework for understanding market movements. More importantly, he developed what he would later describe as his three-pillar approach to trading: fundamentals, technicals, and market tone. The fundamental analysis component involved understanding the underlying supply and demand dynamics of whatever commodity he was trading. This wasn't just about looking at inventory reports or weather patterns, but understanding the deeper economic forces that could create sustained price movements. Marcus developed an almost intuitive feel for these macro trends, often positioning himself months ahead of major market moves. The technical analysis aspect focused on chart patterns, trend identification, and momentum indicators. But Marcus's approach to technical analysis went beyond simple pattern recognition. He understood that charts were essentially a visual representation of human psychology, showing the collective emotions and decisions of market participants. His background in psychology gave him unique insights into these behavioral patterns. The third pillar, market tone, was perhaps the most sophisticated aspect of his approach. This involved reading the subtle psychological shifts in market sentiment, understanding how news was being interpreted by different market participants, and recognizing when the crowd was positioned incorrectly. Market tone required not just analytical ability, but genuine intuition about human nature and crowd psychology. By the mid-1970s, Marcus had refined this three-pillar approach to the point where he was generating consistent profits for both himself and the firm. His personal trading account, which had started modestly, was beginning to show the kind of exponential growth that would eventually make him a legend. More importantly, his success was attracting attention from other traders who wanted to learn from his methods. The commodity markets of the 1970s provided the perfect backdrop for Marcus's emerging expertise. The decade began with Nixon's wage and price controls creating artificial distortions throughout the economy. The Watergate scandal and subsequent political instability added another layer of uncertainty. The oil embargo of 1973 quadrupled energy prices virtually overnight. Currency markets were in constant turmoil as the Bretton Woods system collapsed and floating exchange rates became the new reality. For most investors, this period was characterized by confusion and losses. Traditional investment strategies that had worked for decades suddenly became obsolete. But for a trader with Marcus's skills and mindset, this volatility represented unprecedented opportunity. Every crisis created price dislocations, and every dislocation represented a potential profit opportunity for someone willing to take calculated risks. Marcus's breakthrough year came in 1979, a year that would forever be remembered as one of the most dramatic in commodity market history. The Iranian Revolution had disrupted global oil supplies, sending prices soaring. Energy double-digit inflation was ravaging the U.S. economy, prompting investors to flee paper assets in favor of hard commodities. Gold, which had been artificially suppressed at $35 per ounce for decades, was finally free to find its market value was a seemingly, but an unrelated event halfway around the world that would provide Marcus with his most legendary trade. On December 24, 1979, Soviet forces invaded Afghanistan, triggering a geopolitical crisis that would have profound implications for global markets. While most of the world was focused on the military and political ramifications of this invasion, Marcus immediately recognized its potential impact on commodity prices. The invasion created a level of international uncertainty that hadn't been seen since the Cuban Missile Crisis. Investors around the world began fleeing to safe haven assets, with gold being the primary beneficiary of this flight to safety. But Marcus's advantage wasn't just in recognizing this trend, it was in his ability to act on it before the rest of the market fully understood what was happening. Marcus was in California when he heard news of the invasion on television. While the rest of America was sleeping, he immediately called his contacts in Hong Kong to gauge market reaction. What he discovered was that Asian markets hadn't yet absorbed the significance of the news. Gold prices were still trading at their previous levels, completely unaware of the geopolitical earthquake that was about to shake global markets. This was the moment when all of Marcus's training, discipline, and market understanding crystallized into action. He began buying gold futures aggressively, eventually accumulating a position of 200,000 ounces, worth approximately $40 million at the time. This wasn't just a large trade, it was a massive bet that required tremendous conviction and risk tolerance. The beauty of Marcus's position wasn't just its size, but its timing. He had positioned himself ahead of what would become one of the most dramatic commodity moves in modern history. As news of the invasion spread around the globe, gold prices began their historic ascent. The metal that had traded around $300 per ounce at the beginning of 1979 would eventually peak at over $100 per ounce by January 1980. But Marcus's genius wasn't just in buying gold, it was in how he managed the position as it became profitable. Rather than simply holding and hoping, he employed a sophisticated pyramiding strategy that maximized his profits while managing his risk. As gold prices rose and his position became more profitable, he would add to his holdings, effectively compounding his gains on the way up. The global nature of gold trading allowed Marcus to take advantage of what he called the follow the sun strategy. He would buy gold in Australia during their trading hours, watch it rally $10 in Hong Kong, see it gain another $10 in London, and then sell out at a $30 profit when New York markets opened. This 24-hour trading approach gave him significant advantages over competitors who were limited to their local time zones. As gold continued its relentless climb throughout 1979 and into 1980, Marcus's position became increasingly valuable. His original $40 million position was generating profits that dwarfed anything he had achieved previously. The psychological pressure of managing such a large, profitable position would have crushed most traders, but Marcus's years of training and discipline allowed him to stay focused on his systematic approach. The profits from his gold trade alone were staggering, but they represented just one component of what would become Marcus's most successful year. He was simultaneously running profitable positions in silver, which was experiencing its own dramatic bull market, as well as various agricultural commodities that were benefiting from inflationary pressures and weather-related supply disruptions. By the end of 1979, Marcus had achieved something that most professional traders only dream about. He had multiplied his trading capital by several times over in a single year. His account balance had grown from millions to tens of millions, establishing him as one of the most successful commodity traders of his generation. But perhaps more importantly, Marcus had proven to himself and the trading world that his systematic approach to market analysis could generate extraordinary returns even during the most challenging market conditions. The combination of fundamental analysis, technical expertise, and psychological insight had created a trading methodology that was both robust and scalable. The success of his gold trade also demonstrated another crucial aspect of Marcus's approach, his ability to connect geopolitical events with market movements before the broader investment community understood these relationships. This global perspective and rapid decision-making ability would become hallmarks of his trading style throughout the remainder of his career. As word of his spectacular performance spread throughout the trading community, Marcus found himself in an entirely new position. He was no longer the struggling psychology student who had nearly been wiped out by early trading losses. He was now recognized as one of the premier commodity traders in the world, someone whose methods and insights were eagerly studied by aspiring traders everywhere. The success of Marcus's gold trade transformed him from a struggling trader into a market legend. But this newfound status brought with it an entirely different set of challenges and responsibilities. Success in trading often creates its own problems, and Marcus was about to learn that managing wealth and reputation could be just as difficult as generating profits in the first place. The psychological impact of such extraordinary success cannot be understated. Within the span of a few years, Marcus had gone from nearly being wiped out of the markets to becoming one of the wealthiest traders in the world. This dramatic transformation required significant mental adjustments, as he had to learn how to think and operate on a completely different scale than ever before. The trading community took notice of Marcus's spectacular performance, and suddenly everyone wanted to know his secrets. Fellow traders, financial journalists, and aspiring speculators all sought access to the man who had seemingly cracked the code of commodity trading. But Marcus understood something that many successful traders fail to grasp. The moment you start believing your own hype is often the moment your performance begins to decline. Rather than becoming complacent or overconfident, Marcus used his success as motivation to refine his approach even further. He recognized that the markets were constantly evolving, and strategies that worked in one environment might fail completely in another. This intellectual humility and willingness to adapt would prove crucial as the 1980s brought entirely new market dynamics and challenges. The commodity markets that had provided such extraordinary opportunities during the 70s were beginning to mature and become more efficient. The same price dislocations that had generated massive profits for Marcus were becoming harder to find as more sophisticated participants entered the markets. Computer-driven trading systems were beginning to emerge, and the old-fashioned approach of pure fundamental analysis was being supplemented by quantitative methods. Marcus embraced these changes rather than resisting them. His background in psychology had taught him that adaptation was essential for survival, whether in human behavior or market dynamics. He began incorporating more technical analysis into his approach, using chart patterns and momentum indicators to refine his entry and exit timing. The integration of technical and fundamental analysis wasn't just an intellectual exercise for Marcus. It represented an evolution in his understanding of how markets actually function. He came to realize that prices often move in anticipation of fundamental changes rather than in response to them. This insight allowed him to position himself ahead of major moves rather than chasing them after they had already begun. During this period, Marcus also began expanding his focus beyond traditional agricultural commodities into currency markets. The foreign exchange market was experiencing unprecedented volatility as central banks struggled to manage inflation and maintain currency stability. For a trader with Marcus's global perspective and analytical skills, these currency fluctuations represented enormous profit opportunities. His success in currency trading demonstrated the universality of his approach. The same principles that had worked in corn and wheat futures, understanding supply and demand dynamics, recognizing trend changes, and managing risk effectively, proved equally applicable to dollar-yen or pound-sterling movements. This adaptability across different asset classes separated Marcus from traders who specialized in only one particular market. But perhaps the most significant development during this period was Marcus's emergence as a mentor to the next generation of trading talent. His success had attracted attention from aspiring traders who recognized that learning from someone of his caliber could accelerate their own development by decades. Among these eager students was a young man named Bruce Kovner, who would eventually become one of the most successful hedge fund managers in history. The relationship between Marcus and Kovner exemplified the importance of knowledge transfer in the trading world. Marcus understood that his success wasn't just about his individual achievements, but about contributing to the broader development of trading as a professional discipline. He took seriously his role as a teacher and mentor, recognizing that the principles he had learned could benefit others if properly transmitted. Kovner arrived at Commodities Corporation as a relatively inexperienced trader, but he possessed the same intellectual curiosity and psychological resilience that had characterized Marcus's own early development. Under Marcus's guidance, Kovner began learning not just the technical aspects of trading, but the mental framework necessary for long-term success. The lessons Marcus taught Kovner went far beyond simple trading techniques. He emphasized the paramount importance of risk management, explaining that even the best analysis in the world was worthless if you didn't survive long enough to benefit from being right. He taught Kovner about the psychological traps that destroy most traders: overconfidence after wins, revenge trading after losses, and the tendency to increase position size at exactly the wrong moments. Perhaps most importantly, Marcus taught Kovner that making millions of dollars was actually possible for someone with the right approach and discipline. This might seem obvious in retrospect, but for a young trader starting with borrowed money, the psychological barrier of believing that extraordinary success was achievable represented a crucial hurdle. Marcus's own example provided concrete proof that ordinary individuals could achieve extraordinary results through skill and determination. The mentoring relationship also worked both ways, as teaching forced Marcus to articulate and refine his own methods. Explaining complex market concepts to someone else required him to think more clearly about why certain approaches worked and others failed. This process of teaching actually enhanced his own trading, as it forced him to be more systematic and consistent in his decision-making. As Kovner's skills developed under Marcus's tutelage, their relationship evolved into something more like a partnership. They would analyze market conditions together, sharing insights and challenging each other's assumptions. This intellectual collaboration pushed both traders to higher levels of performance, demonstrating the value of surrounding yourself with other talented individuals who can enhance your own abilities. The success of this mentoring relationship had broader implications for Commodities Corporation as an institution. The firm became known throughout the financial industry as a breeding ground for trading talent, attracting ambitious individuals who wanted to learn from the best. This reputation allowed the company to recruit exceptional people and create a culture of excellence that elevated everyone's performance. Marcus's role in developing this culture cannot be overstated. His combination of analytical rigor, psychological insight, and generous mentorship created an environment where talented individuals could flourish. The firm's track record of producing successful traders wasn't accidental. It was the direct result of systematic approaches to talent development pioneered by Marcus and his colleagues. During the early 1980s, Marcus found himself managing increasingly large positions across multiple markets simultaneously. His personal trading account had grown to the point where his individual trades could move market prices, requiring even more sophisticated execution strategies. The challenge was no longer just identifying profitable opportunities, but implementing them without disrupting the very markets he was trying to profit from. This scaling challenge forced Marcus to develop new approaches to position management and execution. He learned to break large trades into smaller pieces, spreading his buying or selling across multiple time periods to minimize market impact. He also began using more sophisticated hedging strategies to manage the overall risk of his portfolio while maintaining exposure to the trends he wanted to capture. The mathematical complexity of managing such large, diversified positions required Marcus to think like a portfolio manager rather than just a trader. He developed systematic approaches to correlation analysis, understanding how movements in one market might affect positions in related markets. This holistic approach to risk management allowed him to take larger positions with greater confidence, knowing that he had accounted for various scenario outcomes. But the growth in position size also created new psychological pressures that Marcus had to learn to manage. The daily profit and loss swings from his trading account were becoming so large that they could be emotionally overwhelming if he allowed himself to focus on them. He developed mental techniques for maintaining emotional equilibrium regardless of short-term fluctuations in his account value. One of these techniques involved focusing on the process rather than the outcomes of individual trades. Marcus learned to evaluate his performance based on whether he had followed his systematic approach correctly, rather than simply looking at whether specific trades made or lost money. This process-oriented mindset helped him maintain discipline even during inevitable losing streaks. The discipline required to manage such large positions while maintaining emotional balance cannot be understated. Most traders struggle with position sizing even when dealing with relatively small amounts of capital. The psychological pressure of managing tens of millions of dollars in open positions would crush the majority of market participants. But Marcus had developed the mental toughness necessary to thrive under such conditions. His success during this period also attracted unwanted attention from competitors and market observers who were trying to figure out his methods. Marcus learned to operate with greater discretion, understanding that his trading activities were being monitored by others who might try to front-run his positions or fade his strategies. This cat-and-mouse game with other market participants added another layer of complexity to his operations. The need for operational security led Marcus to develop more methods and sophisticated execution communication protocols. He worked with multiple brokers to disguise the full size of his positions, and he learned to vary his trading patterns to avoid creating predictable footprints that others could exploit. These operational improvements were just as important as his analytical capabilities in maintaining his competitive edge. As the 1980s progressed, Marcus found himself operating at the absolute pinnacle of the trading world. His track record had established him as one of the most successful commodity speculators in history, and his methods were being studied and emulated by traders around the globe. But rather than resting on his accomplishments, he continued pushing the boundaries of what was possible in terms of both returns and risk management. The evolution of his trading approach during this period reflected not just his individual growth, but the broader maturation of financial markets themselves. The same entrepreneurial spirit that had driven his early success now manifested itself in continuous innovation and adaptation to changing market conditions. Marcus understood that standing still in the trading world was equivalent to moving backward, as competitors and market dynamics were constantly evolving. His reputation extended far beyond the commodity markets where he had first made his name. Currency traders, equity specialists, and fixed income managers all sought to understand his methods and incorporate his insights into their own approaches. This cross-pollination of ideas helped advance the entire field of systematic trading and risk management. The influence of Marcus's work during this period would eventually extend far beyond his individual trading results. The principles he developed and refined, systematic risk management, trend following, psychological discipline, and adaptive execution, became foundational elements of modern portfolio management. Countless traders and investment managers would build their careers on variations of the methods Marcus pioneered. But perhaps the most remarkable aspect of Marcus's performance during the 80s was its consistency. While other traders experienced dramatic boom and bust cycles, Marcus maintained steady growth year after year. This consistency wasn't the result of playing it safe or avoiding risk, quite the opposite. It reflected the maturity and sophistication of his approach, which allowed him to take significant risks while maintaining strict control over potential losses. The compounding effect of this consistent performance was extraordinary to witness. Each successful year provided a larger capital base for the following year's trading, creating a virtuous cycle of growth that seemed to accelerate over time. By the mid-80s, Marcus's personal trading account had reached levels that few individuals in history had ever achieved through pure speculation. Yet despite this incredible success, Marcus remained grounded and focused on continuous improvement. He understood that the moment a trader becomes overconfident or complacent is often the beginning of their downfall. The markets have a way of humbling even the most successful participants, and Marcus had seen too many talented traders destroyed by their own success to let his guard down. This combination of extraordinary achievement and intellectual humility would define Marcus's approach throughout the remainder of his legendary career. He had proven that systematic methods, disciplined execution, and psychological resilience could generate returns that seemed almost impossible to believe. But he also understood that maintaining such performance required constant vigilance and adaptation to ever-changing market conditions. The influence Marcus wielded during the peak of his career extended far beyond the impressive numbers in his trading accounts. By the mid-1980s, his methods had become the subject of intense study throughout the professional trading community. Investment banks were hiring consultants to reverse engineer his approaches. Academic researchers were writing papers attempting to quantify his edge. Even central bank officials were monitoring his positions to gauge potential impacts on their monetary policies. This level of scrutiny would have intimidated most traders, but Marcus viewed it as validation of his systematic approach. He understood that if his methods could withstand the analysis of the brightest minds on Wall Street and still generate consistent profits, then he had truly developed something special. The fact that others were trying to copy his techniques didn't concern him, because he knew that successful trading required more than just following a set of rules. The psychological component of his approach was perhaps the most difficult aspect for others to replicate. Marcus had spent years developing the mental discipline necessary to execute his strategies flawlessly, even under extreme pressure. This wasn't something that could be learned from a textbook or copied by observing his trades. It required the kind of hard-won experience that only comes from surviving multiple market cycles and learning from countless mistakes. During this period, Marcus began sharing more of his insights through carefully selected interviews and speaking engagements. He was approached by Jack Schwager for what would become the landmark book Market Wizards, an opportunity that would cement his legacy as one of the greatest traders in history. The decision to participate in this project wasn't made lightly, as Marcus valued his privacy and operational security. However, he recognized that sharing his story could benefit the broader trading community while also establishing a permanent record of the principles he had developed over decades of market participation. The interview process forced him to articulate concepts that he had previously operated on more intuitively, creating a clearer framework that others could potentially learn from. The Market Wizards interview revealed aspects of Marcus's personality and approach that hadn't been widely known before. His emphasis on the importance of being wrong frequently while still making money challenged conventional wisdom about trading success. Most people assumed that great traders were right more often than they were wrong, but Marcus explained that his success came from making his winners much larger than his losers. This concept of asymmetric risk-reward was revolutionary for many readers who had never considered that trading could be profitable even with a relatively low percentage of winning trades. Marcus's explanation of how he could be wrong 60% of the time and still generate extraordinary returns opened up entirely new ways of thinking about market participation for countless aspiring traders. The interview also highlighted his sophisticated understanding of market psychology and crowd behavior. Marcus explained how he would often position himself opposite to conventional wisdom, but only when his analysis suggested that the crowd was positioned incorrectly. This contrarian element of his approach required tremendous conviction and psychological strength, as it meant taking large positions that initially appeared to be moving against him. His discussion of the three-pillar approach, fundamentals, technicals, and market tone, provided a framework that traders could adapt to their own circumstances and markets. But Marcus was careful to emphasize that simply following this framework wasn't enough. Success required developing the judgment to know when all three pillars were aligned and the conviction to act decisively when such opportunities presented themselves. The publication of Market Wizards transformed Marcus from a legendary figure known primarily within professional trading circles into a household name among serious investors worldwide. Suddenly, traders from around the globe were studying his methods and trying to incorporate his principles into their own approaches. Business schools began including his interview in their curriculum, and investment management firms started recruiting specifically for candidates who understood his methodologies. This broader recognition brought both opportunities and challenges. On one hand, Marcus found himself inundated with requests for consulting engagements, speaking opportunities, and investment partnerships. The financial rewards from these activities could be substantial, and they offered ways to leverage his expertise beyond his personal trading activities. On the other hand, the increased visibility made it more difficult to maintain the operational security that had been crucial to his success. The challenge of managing fame while maintaining trading performance is something that few individuals ever face, but Marcus navigated it with the same systematic approach he applied to market analysis. He established clear boundaries around his time and availability, ensuring that external commitments didn't interfere with his primary focus on trading. He also developed sophisticated screening processes to identify which opportunities aligned with his long-term objectives and which were simply distractions. During the late 1980s, Marcus began contemplating the next phase of his career. He had achieved financial success beyond his wildest early dreams, established himself as one of the premier traders in history, and contributed significantly to the development of systematic trading methodologies. The question now was how to use this platform to create even greater impact and legacy. One option was to establish his own investment management firm, leveraging his track record to attract institutional capital and scale his methods to even larger levels. Many successful traders had followed this path, building multi-billion-dollar hedge funds that could generate substantial management fees while continuing to pursue trading profits. The infrastructure and regulatory requirements would be significant, but Marcus had the resources and reputation to make such a venture successful. Another possibility was to focus more heavily on education and knowledge transfer, perhaps establishing a formal training program or writing a comprehensive book about his methods. Marcus had already demonstrated his effectiveness as a mentor through his work with Bruce Kovner and other traders at Commodities Corporation. Scaling this mentoring capability could potentially impact thousands of future traders while creating a lasting educational legacy. A third option was to transition into more of an advisory role, working with institutional investors, central banks, and government agencies to help them understand and navigate increasingly complex global markets. Marcus's combination of practical trading experience and theoretical understanding made him uniquely qualified to bridge the gap between academic research and real-world market dynamics. The decision about which direction to pursue was complicated by the rapidly changing nature of financial markets themselves. The late 80s saw the emergence of program trading, portfolio insurance, and other quantitative techniques that were beginning to alter the character of market movements. Personal computers were becoming powerful enough to run sophisticated analytical software, democratizing access to tools that had previously been available only to large institutions. These technological changes represented both opportunities and threats for someone with Marcus's background. On one hand, better analytical tools could enhance his already sophisticated approach to market analysis and risk management. On the other hand, the democratization of these capabilities meant that his competitive advantages might erode as more participants gained access to similar methodologies. Marcus approached these challenges with characteristic thoughtfulness and strategic planning. Rather than viewing technological change as a threat, he saw it as an evolution that required adaptation and continuous learning. He began investing in computer systems and software, not to replace his judgment-based approach, but to enhance it with better data analysis and position management capabilities. The integration of technology into his trading process wasn't just about adopting new tools, it required rethinking fundamental aspects of his approach. Computer-driven analysis could process vast amounts of data much faster than human analysis, potentially identifying patterns and relationships that might be missed through traditional methods. However, the interpretation of this analysis still required human judgment and market intuition. Marcus found that the most effective approach was to use technology as a complement to, rather than a replacement for, his traditional methods. Computer analysis could help him identify potential opportunities and monitor risk parameters, but the final decisions about position sizing, entry timing, and exit strategies still relied on his years of experience and market feel. This hybrid approach proved to be remarkably effective as it combined the speed and accuracy of computer analysis with the nuanced understanding of market psychology that only comes from decades of direct market participation. Marcus was able to maintain his competitive edge while adapting to the changing technological landscape, demonstrating once again his ability to evolve with changing market conditions. The success of this technological integration also influenced his thinking about the future structure of trading organizations. Marcus began to envision trading operations that combined human expertise with computer-based analysis in systematic ways, creating teams that could leverage the strengths of both approaches. This vision would later influence the development of quantitative hedge funds and systematic trading strategies that dominate modern financial markets. As the 1980s drew to a close, Marcus found himself reflecting on the extraordinary journey that had brought him from a struggling psychology student to one of the most successful traders in history. The transformation had required not just intellectual development, but fundamental changes in his understanding of risk, probability, and human nature. The lessons learned through years of market participation had applications far beyond trading, touching on broader questions about decision-making, risk management, and performance under pressure. The financial rewards from his trading success had certainly been substantial, but Marcus increasingly recognized that his most lasting contributions might be in the areas of education and methodology development. The principles he had refined through decades of market participation could potentially benefit countless other individuals, not just in trading but in any field that required systematic decision-making under uncertainty. This realization led Marcus to begin thinking more strategically about how to structure the next phase of his career. Rather than simply continuing to trade larger and larger positions, he started considering ways to multiply his impact through teaching, mentoring, and institutional development. The question wasn't whether he could continue generating impressive returns. His track record had already established that capability. The question was how to use his expertise to create the greatest possible positive impact. The evolution of his thinking during this period reflected a maturity that goes beyond financial success. Marcus had learned that true achievement isn't just about accumulating wealth, but about contributing something meaningful that outlasts individual accomplishments. The methods he had developed and the principles he had refined could potentially influence trading practices for generations to come, creating a legacy far more significant than any single trading performance. As he contemplated these broader questions, Marcus continued to execute his systematic approach with the same precision and discipline that had characterized his entire career. The daily routine of market analysis, position management, and risk control continued unchanged, even as he planned for fundamental shifts in his long-term objectives. This ability to maintain operational excellence while simultaneously planning strategic transitions demonstrated the same mental discipline that had made him such a successful trader. The consistency of his performance during this transitional period was particularly remarkable, as many successful individuals struggle to maintain their edge while contemplating major life changes. Marcus's ability to compartmentalize different aspects of his thinking, keeping his trading decisions separate from his career planning, reflected the psychological sophistication that had been crucial to his success throughout his career. The lessons from this period of Marcus's life extend far beyond trading into broader questions about how successful individuals manage transitions and maintain performance while evolving their objectives. His systematic approach to both market analysis and life planning provided a template that others could adapt to their own circumstances, whether in finance or entirely different fields. The integration of short-term tactical excellence with long-term strategic planning became another hallmark of Marcus's approach during this period. He demonstrated that it was possible to maintain peak performance in current activities while simultaneously preparing for future transitions, provided that both aspects were approached with the same systematic rigor and disciplined execution. This balance between present focus and future planning would prove crucial as Marcus navigated the complex decisions about how to structure the next phase of his career. The foundation of consistent trading performance provided him with the financial security and credibility necessary to pursue whatever direction he ultimately chose, while his systematic approach to decision-making ensured that these choices would be made thoughtfully rather than impulsively. The period also demonstrated Marcus's ability to maintain his competitive edge even as the markets themselves were evolving rapidly. The late 80s saw significant changes in market structure, participant behavior, and available technologies. Yet Marcus continued to generate impressive returns by adapting his methods without abandoning the core principles that had made him successful. This adaptability, without compromise of fundamental principles, became another key lesson for aspiring traders and other professionals facing rapidly changing competitive environments. Marcus showed that it was possible to evolve with changing conditions while maintaining the disciplined approach that had created success in the first place, provided that the evolution was guided by systematic analysis rather than emotional reactions to change. As Marcus contemplated these fundamental shifts in his career trajectory, the trading world itself was undergoing its own seismic transformation. The emergence of electronic trading platforms, sophisticated risk management software, and global communication networks was democratizing access to markets that had previously been the exclusive domain of well-connected professionals. For someone who had built his success on identifying inefficiencies and exploiting them before others caught on, these changes represented both unprecedented opportunities and existential challenges. The relationship between Marcus and the broader financial community had evolved significantly since his early days as a struggling psychology student with a few $1,000s to his name. Major investment banks were now actively recruiting traders who understood his methodologies. Pension funds and endowments sought his insights on portfolio construction and risk management. Central banks quietly monitored his positions to gauge potential impacts on their monetary policies. This level of institutional recognition was gratifying, but it also created new responsibilities and pressures. Marcus understood that his actions in the markets were no longer just about his personal profit and loss. They had broader implications for market stability and price discovery mechanisms. The size of his positions meant that his trading decisions could influence the very markets he was trying to analyze and predict. The psychological adjustment to operating at this scale required yet another evolution in his mental approach. Early in his career, Marcus had learned to manage the emotional swings of winning and losing relatively small amounts of money. Later, he had adapted to the pressures of managing millions in capital. Now he was operating at levels where individual trades could generate profits or losses equivalent to what most successful businesses earned in entire years. The daily routine that had served Marcus so well throughout his career remained largely unchanged, but the context in which he executed that routine had transformed dramatically. His morning analysis of market conditions now incorporated information from dozens of sources around the globe. His position management decisions affected not just his own account, but potentially the accounts of investors and institutions who tracked his activities. Despite these changes, Marcus maintained the fundamental disciplines that had made him successful. He continued to analyze markets using his three-pillar approach, combining fundamental analysis with technical patterns and market psychology. He maintained strict risk management protocols that limited his exposure on any single trade. Most importantly, he preserved the intellectual curiosity and willingness to adapt that had allowed him to evolve with changing market conditions throughout his career. The challenge of maintaining these disciplines while operating at such large scale was complicated by the increasing sophistication of his competition. The same technological advances that were democratizing market access were also enabling new forms of quantitative analysis and algorithmic trading. Marcus found himself competing not just against other human traders, but against computer systems that could process vast amounts of information and execute trades at speeds impossible for human participants. Rather than viewing this technological evolution as a threat, Marcus approached it as another form of market adaptation that required systematic response. He began incorporating quantitative analysis into his decision-making process, using computer models to identify potential opportunities and monitor risk parameters. However, he was careful to maintain human judgment as the final arbiter of his trading decisions, understanding that successful speculation required insights that went beyond pure mathematical analysis. The integration of quantitative methods with his traditional approach created new possibilities for identifying market inefficiencies. Computer analysis could process correlation relationships between different commodities, currencies, and economic indicators at a scale that would be impossible through manual analysis. This enhanced analytical capability allowed Marcus to identify subtle patterns and relationships that might provide trading opportunities. However, the increasing sophistication of market participants also meant that profitable opportunities were becoming more difficult to identify and exploit. The same price discrepancies that had generated massive profits during the 1970s were being arbitraged away more quickly by better informed and better equipped competitors. Success required not just identifying opportunities, but moving quickly and efficiently to capitalize on them before they disappeared. This evolution in market dynamics forced Marcus to reconsider fundamental aspects of his approach. The holding periods for profitable positions were becoming shorter as information traveled faster and arbitrage became more efficient. The size of individual opportunities was becoming smaller as more participants competed for the same inefficiencies. The complexity of global markets was increasing as financial instruments became more sophisticated and interconnected. Marcus responded to these challenges by diversifying his approach across more markets and time horizons. Rather than focusing exclusively on major commodity trends that might last months or years, he began incorporating shorter-term strategies that could capture profits from temporary price dislocations. This diversification required developing new analytical frameworks and risk management protocols, but it also created multiple sources of potential returns. The expansion into currency markets proved particularly profitable during this period. The foreign exchange market was experiencing unprecedented volatility as central banks struggled to coordinate monetary policies in an increasingly globalized economy. Interest rate differentials between countries created opportunities for carry trades, while political uncertainties generated momentum-driven trends that could be captured through systematic analysis. Marcus's success in currency trading demonstrated the universal applicability of his analytical framework. The same principles that had worked in agricultural commodities, understanding supply and demand dynamics, identifying trend changes, and managing risk effectively, proved equally valuable in analyzing relationships between different national currencies. This adaptability across asset classes reinforced his confidence in the robustness of his overall approach. The psychological demands of trading multiple markets simultaneously required another level of mental discipline. Marcus had to maintain awareness of economic conditions, political developments, and market dynamics across dozens of countries and currencies. The information processing requirements were enormous, and the potential for overlooking critical developments was significant. To manage these demands, Marcus developed systematic information filtering and prioritization processes. Rather than trying to monitor every possible development that might affect his positions, he focused on identifying the most critical variables for each market and tracking those systematically. This approach allowed him to maintain comprehensive market awareness without becoming overwhelmed by information overload. The development of these systematic approaches to information management became another area where Marcus's methods influenced the broader trading community. Investment firms began adopting similar frameworks for organizing their research and analysis processes. The concept of focusing on the most critical variables rather than trying to track everything became a standard practice in professional investment management. Marcus's influence during this period extended beyond trading methodologies into broader questions about market structure and regulation. His success had been built on identifying and exploiting inefficiencies in commodity and currency markets, but the increasing efficiency of these markets raised questions about whether such opportunities would continue to exist in the future. Regulatory authorities were also taking notice of the activities of large speculative traders like Marcus. The size of his positions and their potential impact on market prices led to discussions about whether additional oversight or position limits might be necessary to maintain orderly markets. Marcus found himself participating in policy discussions about the role of speculation in price discovery and market liquidity. These regulatory considerations added another layer of complexity to his trading operations. Marcus had to ensure that his activities complied with evolving rules and regulations while maintaining the flexibility necessary to capitalize on market opportunities. This required developing relationships with compliance professionals and legal experts who could help navigate the increasingly complex regulatory environment. The political dimension of large-scale commodity speculation also became more prominent during this period. Agricultural commodities, in particular, were subject to intense scrutiny from policymakers concerned about food security and price volatility. Marcus's positions in grain markets were sometimes viewed as contributing to price increases that affected consumers around the world. Navigating these political sensitivities required Marcus to develop a more sophisticated understanding of the broader social and economic implications of his trading activities. While he remained committed to pursuing profitable opportunities, he also became more conscious of how his actions might be perceived by policymakers and the general public. The tension between private profit and public good became an ongoing theme in Marcus's thinking during this period. He understood that speculation served important economic functions by providing liquidity and facilitating price discovery, but he also recognized that large speculative positions could sometimes contribute to market volatility that had negative consequences for other market participants. This awareness led Marcus to become more selective about the opportunities he pursued, focusing on situations where his activities were more likely to improve market efficiency rather than contribute to destabilizing speculation. This self-imposed constraint required him to develop even more sophisticated analytical capabilities to identify truly exceptional opportunities that met both his profit objectives and his ethical standards. The evolution of his thinking about the social responsibilities of successful speculators reflected Marcus's broader maturation as both a trader and a public figure. The young psychology student who had started trading with a few $1,000s had developed into someone whose decisions affected global markets and whose methods influenced an entire generation of financial professionals. This sense of responsibility extended to his role as a mentor and teacher. Marcus began taking more seriously his obligations to share his knowledge and expertise with the next generation of traders. The success of his mentoring relationship with Bruce Kovner had demonstrated the potential impact of effective knowledge transfer, and Marcus began looking for ways to scale these efforts. The challenge of sharing complex trading knowledge with a broader audience was significant. The principles that had made Marcus successful were often subtle and context-dependent, requiring years of experience to implement effectively. Simply explaining his methods wasn't enough. Students needed to develop the judgment and discipline necessary to apply these principles in real market conditions. Marcus began experimenting with different approaches to education and knowledge transfer. He participated in selected conferences and seminars, sharing insights about market analysis and risk management with professional audiences. He also began working more closely with academic researchers who were studying systematic approaches to investment management and speculation. The academic interest in his methods was particularly gratifying, as it suggested that his approach had theoretical as well as practical validity. Researchers were beginning to develop formal models that captured some of the principles Marcus had discovered through trial and error over decades of market participation. This academic validation provided additional confidence that his methods could be taught and replicated by others. However, Marcus remained skeptical about the ability of purely academic approaches to capture the full complexity of successful trading. The psychological and intuitive elements of his approach were difficult to quantify and model, yet they were often the most critical factors in determining success or failure in real market conditions. The ongoing dialogue between practical trading experience and academic research became another area where Marcus made significant contributions. He helped bridge the gap between theoretical understanding and practical application, translating complex market concepts into frameworks that could be understood and implemented by others. This bridging role was particularly valuable in the area of risk management, where academic models often failed to capture the dynamic nature of real market risks. Marcus's practical experience with managing large positions through multiple market cycles provided insights that complemented and enhanced theoretical approaches to risk measurement and control. The combination of practical experience and theoretical understanding made Marcus uniquely qualified to comment on broader questions about market efficiency and the role of speculation in financial systems. His insights were sought by policymakers, regulators, and academics who were trying to understand how markets actually function and how they might be improved. During the late 80s, Marcus found himself increasingly involved in discussions about the future structure and regulation of financial markets. His unique perspective as someone who had both profited enormously from market inefficiencies and contributed to making markets more efficient through his trading activities gave him credibility with diverse audiences. These policy discussions provided Marcus with another outlet for his intellectual energy and analytical capabilities. The same systematic thinking that had made him successful in trading proved valuable in analyzing complex policy questions about market structure and regulation. His contributions to these discussions helped shape the evolution of financial markets in ways that extended far beyond his individual trading results. The recognition that his influence extended beyond pure profit generation was both satisfying and sobering. Marcus had achieved financial success beyond his original dreams, but he was beginning to understand that his most lasting contributions might be in the areas of methodology development and knowledge transfer rather than simply accumulating wealth. This realization led to a gradual shift in his priorities and objectives. While he continued to pursue profitable trading opportunities with the same discipline and intensity that had characterized his entire career, he began allocating more time and energy to activities that could have broader and more lasting impact. The process of rebalancing his priorities was complicated by the ongoing demands of managing large trading positions. Markets don't pause for personal reflection or career planning, and Marcus had to maintain his operational excellence while simultaneously evolving his long-term objectives. This required the same kind of compartmentalization and mental discipline that had served him throughout his trading career. The ability to maintain peak performance in current activities while planning for future transitions became another hallmark of Marcus's systematic approach to both trading and life management. He demonstrated that it was possible to evolve personal and professional objectives without compromising the disciplines that had created success in the first place. As the 1980s drew to a close, Marcus had established himself as one of the most successful and influential traders in history. His transformation from struggling psychology student to market legend represented one of the most remarkable individual achievements in the annals of financial speculation. But perhaps more importantly, his systematic approach to trading and risk management had influenced an entire generation of financial professionals and contributed to the development of modern investment methodologies. The principles Marcus had developed through decades of market participation, systematic analysis, disciplined risk management, psychological resilience, and continuous adaptation had applications far beyond trading. Business leaders, athletes, military officers, and professionals in countless other fields began studying his methods and adapting them to their own circumstances. This broader influence represented the ultimate validation of Marcus's systematic approach to performance under pressure. The fact that his methods could be successfully applied across diverse fields suggested that he had discovered fundamental principles about decision-making and risk management rather than simply developing trading-specific techniques. The universality of these principles also suggested that Marcus's most lasting legacy might be in the area of systematic thinking and disciplined execution rather than simply his impressive trading results. While the financial returns he generated were certainly remarkable, the methodological contributions he made to understanding performance under uncertainty could potentially benefit countless individuals across multiple generations. As Marcus contemplated the next phase of his career, he was increasingly drawn to opportunities that would allow him to share these broader insights with diverse audiences. The question was no longer simply how to generate the highest possible returns, but how to use his expertise and platform to create the greatest possible positive impact. This evolution in thinking reflected not just personal growth, but a sophisticated understanding of how individual achievement could be leveraged to create broader social value. Marcus had learned that true success wasn't just about personal accomplishment, but about contributing something meaningful that could outlast individual careers and benefit others. The systematic approach that had made him successful in trading was now being applied to questions about legacy and social contribution. Marcus approached these broader questions with the same analytical rigor and disciplined thinking that had characterized his market analysis throughout his career. The integration of personal success with social responsibility became another area where Marcus's example influenced others. He demonstrated that it was possible to achieve extraordinary individual results while simultaneously contributing to broader social good, provided that both objectives were approached with systematic thinking and principled execution. Michael Marcus is still alive as of 2025. The story of Michael Marcus proves that extraordinary success isn't reserved for the privileged few with insider connections or mathematical genius. It's available to anyone willing to combine systematic analysis with disciplined execution and psychological resilience. His journey from struggling psychology student to trading legend remains one of the most inspiring transformations in financial history, demonstrating that with the right mindset and methods, seemingly impossible dreams can become extraordinary realities.